Well, good afternoon. My name is Eric Martel, and welcome back to another episode of Breakaway from the Rat Race. And today we have Kyle Mitchell on our podcast. And Kyle Mitchell is a multifamily investor and syndicator. They have a lot of properties in Arizona and Tucson, for example. And so he's a very active investor and very busy and doing some very large projects. So welcome to the show, Kyle.
Eric, thanks for having me on. I'm excited to be here.
Yeah. So I think a lot of the people that are listening to my podcast, they are a lot of them. They're kind of like getting started. So there's a lot of education curve that I have to go through and kind of explain. Kind of how do you get from your 9-to-5 jobs into now all of a sudden being an entrepreneur, the CEO of your company, and then making passive income so that you can have financial freedom. So can you tell me a little bit more about kind of like your path in real estate investment, why you chose real estate investing in the first place?
Yeah, so my path is one that, I did have a 9-to-5 job for 16 years, actually longer than that if you count like high school and all that kind of stuff on part-time jobs. But and then recently, about a year and a half ago, I left my W-2. So happy to share with the listeners on what my process was. But my background was I was a regional manager for a golf management company. Mm-hmm. And I did that for 16 years as a regional manager. And, my company was shrinking. I wanted to be growing. And so I started looking for an alternative career. Now, in 2010 is when I found real estate by house hacking my first house. I bought it as a primary house, but I moved in two of my friends. And, it was a fixer-upper. And as we lived in it and they paid me rent, I fixed it up. Mm-hmm. And then a few years later, I sold that property for a profit. And then I moved those into single-family turnkeys in the Midwest. And I liked that model. However, I wanted to scale faster. And so I started looking for another vehicle. And that's when I found multifamily. And at that time in my career, I really wanted to move into something new. It did take me quite a few years. So I had just saved up a nest egg. And as soon as I found it, it really spoke to me. I fell in love with it. It was the same thing that I had been doing the past 16 years, which is, managing a business. And that's what multifamily is managing a business. It's implementing systems, managing people, driving income and controlling expenses. And so as soon as I saw that, I fell in love with the business model. And 11 months after I found it, I educated myself and I left my full-time job to do this full-time.
Well, congratulations. That's a big step. I think there's some comfort in having a W-2 job, even though there's a lot of hidden risk associated with that people don't really appreciate. But it takes some courage to basically leave that false sense of security behind and then go on it alone. Because if it doesn't work out, it's on you. You have nobody else to blame. You can't say, well, the company didn't go as well, and.
Yeah, I think that you hit it on the head, though. That's the false sense of security, right? Because, with a W-2, you really are reliant on someone else to allow you to work there and certain conditions to keep that job. So, I am now of the mindset. It did take a while to get through that mindset. It took me a year to pull the trigger after I decided. And but now looking back, I'm in control of my own destiny, and all the decisions that I make are made for the betterment of myself, not for the company that I work for that may result in whatever it does, whether it's good or bad for you. So there's certainly risks to both. And in my world, I'd rather have control of those risks.
Yeah, that makes perfect sense. And I think there's a sense, I think even like if you have a very well-paid job, it kind of you kind of have it like an addiction factor, because you're making a lot of money coming in, and then you're just like you're addicted to the lifestyle and all of that. You may not like your job, but it pays the bill and a little bit more, and then you're just like it gets harder, I think, to leave that behind. So
Yeah, definitely. It's just a mindset shift, right? I mean, I think as an entrepreneur, you're certainly putting all the work in up front for a result that you're hoping to be a positive one in the end. And sometimes it takes years and years and even decades to build that up. And so a lot of people like that false sense of security by having a paycheck come in on an every other week basis versus putting the work up front. But certainly you can reap major rewards if you're an entrepreneur and you put in the work up front to really get that result. As far as, a W-2, there's nothing wrong with a W-2 if that's what your personality fits you. When I was in my W-2, I just thought about, man, 30 years from now, do I want to be doing the same thing? And maybe I can retire, maybe not. No, I don't. I'd rather really grind out for the next 5 or 10 years and create the life that I want to live.
Yeah, it makes sense. And I think that what is nice about your path or the road you traveled is really it's typical also of the younger generation that are coming in. They are they're just getting started. They have a job. They're making some money. And then they're talking about doing house hacking. So house hacking is, it's been around forever. I did that when I was younger as well with our first house. When we bought our first house, we couldn't afford it. So we decided to finish the basement and then rent out the basement with, an independent entrance and all of that. So personally, well, I'll let you talk about it. What is your experience with house hacking, and would you do that again? Any lessons learned about house hacking, and would you recommend it for other people?
Yeah, I think when you're just getting started, it's a perfect way to get started. You learn a lot about, what types of things need to happen once you close on a property. At the same time, if you do move someone in, they could help pay for that rent. I learned a lot during that house hack because you don't know what you don't know. So, for example, we paid a contractor to help out with the kitchen, and I ended up giving him the full deposit or the full payment up front. And it was a referral through a friend, so I thought I can trust him, and that person disappeared for 3 months. Wow. And I was luckily able to get a hold of his brother. And this was my last, $8,000 to $10,000 we're talking about. I had to pull everything out of my pocket to put the down payment. Friends and family were telling me that you've got to buy a single family home. You've got to buy your first residence. It's the best time to buy. Looking back, it was a good time. But, I gave him all my money. And like I said, luckily his brother came back and then felt bad and ended up doing the job. But it just wasn't as high quality. And you've got to be careful who you trust, and definitely don't pay a contractor in full up front. A lot of times what they do is they take, the money from one job to source another job, and that keeps rolling over, and it's a big snowball. So, definitely vetting your contractors and knowing who you're working with so you can trust is one of the biggest things. And then also, if you're going to move someone in while you're house hacking, I'm grateful that I had my friends there and not just other residents, because it was a disaster for a while. We didn't have flooring for, a month as we redid the flooring and waited on the contractor. There were cats that were living underneath the house, and so there were fleas everywhere. And so we had to bond the house twice. And so, there's all those types of things. And so it just, it teaches you for sure that real estate is not a perfect investment, but at the same time, if you plan it out and go about it the right way, it can be very lucrative.
Yeah. My house hack, this was our first house that I bought with my wife. And then, so again, we finished the basement, we rented it out, but it was a stranger. And then part of the problem is that then I became like the property manager for this. So I had to, fix toilets and fix this and fix that and do this. And then they stopped, the guy lost his job. Then we had to try to evict them and all of that kind of stuff. And, it's one thing to evict somebody that's far, far away. It's another thing when the person is living in your basement and then they're just creating all kinds of problems and all of that. So it was not a good experience. So that was the last house hack that I did. After that, we just said, okay, well, not a good idea for me. Also, there was also I didn't like the lack of privacy. Like I'm kind of a pretty private person and stuff like that. So I didn't like to have somebody kind of like walking in when, we're having a barbecue or something like that.
Yeah. I think for me, I would probably house hack, but not move someone in. So if I were to purchase another home that maybe I wanted to live in, it was in the perfect location, but it needed some work, and it was my wife and I. Yeah, we'd maybe cordon off one section of the house and then do the rest and then move over to the other part of the house. But it's a fantastic way for people to add value to a property. And, you know, I know people who do that every 3 to 4 years. They'll go in, you know, they'll fix it up and then they'll leave. And when you sell, if you're in the property for 2 out of the 5 years, you actually do not have to pay any tax on the profits, up to $250 if you're single and up to $500,000 if you're married. And so a lot of people do that, and it's a source of income for them.
Oh yeah, absolutely. I think it's a great idea. I just want to make sure that, you know, people, if they do that, they understand that it is, you know, it's an experience. Let's just say.
No doubt about it.
Think about it. If you're very particular about your things and very private person, might be, you know, you just have to realize that you're giving up something to get that. But all in all, yeah, I mean, if we didn't have house hacking, we wouldn't have been able to buy that house. And then when we sold it, I mean, we made money on obviously on that was tax free and all of that. So, you know, there is some benefits, but you just have to, you know, delay gratification and then imagine that, okay, I'm giving up some things today for something better later on.
Yeah, if I didn't house hack the first house, I wouldn't have had the capital to go in and start buying, you know, the turnkeys, and then which eventually got me into multifamily. So, you know, definitely it was delaying gratification, but ultimately it was worth it to catapult me into the space where I could actually purchase and buy real estate on my own.
Yeah. So after that, after the house hacking experience and all that, then you moved into single family, turnkey single family, or just single family rentals that you did like a BRRRR strategy?
The first one I purchased was in California, and it was a single family home that was not a BRRRR, and I put in a California resident that knew what he was doing, and I had to evict him. And, you know, 6 to 7 months later, I said, I'm never investing in California again. The landlord-tenant laws out here are outrageous. And so that's when I took my funds. I sold that house, still ended up making a small profit because I was the realtor on that deal. So I was able to save on the commission. But nonetheless, it was 6 to 7 months of stress. That's when I sold and took my capital and started buying turnkeys out of state in the Midwest.
Okay. So where in the Midwest?
Yeah, so I started with Arkansas because it is one of the most landlord-friendly states in the nation, if not the most friendly. 5 days and you can be evicted. And so, knock on wood, never had a late payment in rent on those properties. And that's where I first started buying. And, you know, I broke my one rule by buying in the next market. My one rule is to only purchase going forward in landlord-friendly states. And I unfortunately saw cash flow and my, you know, eyes got blurry, and I went to Chicago and purchased in Chicago. And the cash flow is 3 to 4 times what it was in Arkansas. But, you know, what looks good on paper does not always look good in actual reality. And so, you know, for the first 12 months, those properties performed well. But for the last 2 years, they really haven't. I've had a ton of evictions. Eviction processes take 3 to 4 months in Chicago. They're expensive. And unfortunately, I didn't buy in a great neighborhood either. So it's hard to get good residents in there. I've sold 2 of them, but I still have 2, and they're a little underwater. So I've just got to lease them up and kind of break even until I can sell them when they've appreciated a little bit more and I pay down my debt.
Wow. So Arkansas, where in Arkansas? I was looking at Little Rock, Arkansas.
Yep. I have one in Little Rock and one in Sherwood, and those are about two hours from one another. The Little Rock property's done really well. Haven't seen a lot of appreciation in the rents as much as I'd like to see, but, you know, a constant bump on a year-over-year basis. And like I said, I've never seen a late payment in that market, which is fantastic.
Yeah, that's good. I mean, that's very good.
And then I also own in Ohio, in Dayton, Ohio. I have 3 homes there. Well, I had 3 homes. I sold 2, so I have 1 now. But so basically, I built my portfolio up to 9 single-family homes. And once you get to that 10th, you've got to restructure how you're going to do things, because the lender will, for financing, it's tougher to get financing after your 10th loan. And so that's when I started taking a look around and saying, hey, is there another way? How can I scale? Because single family, it was tough for me to scale. And so that's when I started looking around and found multifamily.
Okay. So that's, So that's very interesting about Little Rock, because I was looking at that market as well. I mean, our first criteria when we look at the where we're going to invest, I mean, that's the first thing that we look at is landlord-friendly estates.
Yep.
So that was critical. And then we look more about the demographics and stuff like that when we look at the different metropolitan areas in terms of kind of like business diversification, unemployment, and all of that. And we kind of dive in, and then we dive into the neighborhood. But so Dayton, Ohio, as you know, I mean, we are in Cleveland. We do a lot of investment in Cleveland and around that area. And that's, we're very happy with Ohio. I think it's a great place to invest. Cleveland, we really like, and then we have a great team on the ground there. So that's very good. Sounds like you had a good experience in Dayton as well.
Yeah, those houses have done fine. I just, I'm not a huge proponent of single family as much as I am multifamily now, but it doesn't mean you can't be successful in single family. I mean, I know tons of people that are successful in single family and do well. I just understand the business model of multifamily because of my past experience running the golf courses. So multifamily really speaks to me, and I love doing it. And I love being an owner operator. And so I love how multifamily has multiple ways to control the business, multiple line items, multiple income line items, and expense items. Yeah. So for me, I can be more creative and also control some of those items.
Yeah. So and I think the single family rental, I think it's a great business, great way to get in for somebody that is brand new. I mean, you had a real estate experience and license before, so you got some training and some understanding of how the real estate market works. Not everybody is like that. So I think for me, like the single family rental, it's a good way to get started, know kind of what you like and what that entails, whether you're a landlord type person, and then you can kind of set up your organization to make it work and decide that this is really something that you want to do. And then there comes a time where at the 10th, when it's time to get your 10th mortgage or whatever, you have to find a different structure for your loans. Either do like a portfolio loan or something like that, or get married.
Yeah. I wouldn't suggest making the decision to get married based on getting more loans, but yeah, definitely. If you're married, you can get up to 20 now, right? One per spouse or 10 per spouse. So
yeah. So that's the other option, but then you're still then you're just delaying the decision, obviously.
Yep.
And then multifamily. So tell me a little bit more about kind of like your transition to multifamily. You basically said that, you had a lot of experience. You're kind of like, you already like the idea that it feels more like you're managing a business. And then, so tell me more about that transition when you were starting to look for that first multifamily, and then kind of like your process for doing that.
Yeah, for me, I was not actually looking for multifamily specifically when I was looking for a new career. And at that point, I was just thinking of the single families. And then when I found multifamily, by just searching online and thinking about different ways that I can lead my golf career, I ran across multifamily and I said, man, there's no way that I could buy apartments. And that's a mindset thing, It's all about mindset. And so there was a cheap course online that I ended up taking. It took 3 weeks. My wife and I did it, and my mind was blown, and I fell in love with it. And so at that point, we created our company within a month and started a meetup. And from there, we just started building our network, educating ourselves. I was driving an hour and a half to 2 hours every day to and from work. And so I would listen to ebooks or audiobooks and podcasts, and I listened to them on 2 speed. So I'm doubling the amount of information that I'm getting. So, I did that for 11 months, and I learned a lot, and I would go to meetups after work and things like that. Yeah. And then at the 11-month mark, the reason why I decided to leave my job before we even had purchased our first multifamily was because we had picked our markets, we had built our team, we felt like our investor database was strong enough. And so we were starting to make active offers. And there's different job duties that you can go into multifamily and be a part of a team in. You can be an underwriter, a deal finder, you can bring network liquidity. There's all those things, but my background is an operator. And so I wanted to be a lead sponsor and an operator. And when you're doing that, you're kind of involved in every aspect of multifamily and the business. Yeah. And I just knew if I wanted to be successful in it, I would need to jump head first, and I would not be able to juggle my full-time job and this company at the same time. And so, for respect out of my company as well, I wanted to make sure that they were getting my full attention, which they were not, which is why I left and pursued multifamily full time. And 2 months later, we ended up getting our first property out in Tucson.
Right. And then, okay, so that sounds good. So you mentioned something about investor database. So you took the course, all of that, and you say, this is what I want to do. And then, there are different roles especially when you're looking on the larger projects, there are different roles associated that can come in to play to facilitate a multifamily kind of deal. But you mentioned something about the investor database. So you started to build an investor database. So how did you do that?
Yeah, it started very slowly, but as you meet people, it's important to tell them what you're doing and what you're interested in. And it's very surprising how many people are interested to hear about it, Yeah. So that was one of the ways. The other way was we were going to meetups. I mean, my wife and I would go to meetups after work 3 or 4 times a week. I would go on the weekends, and you collect business cards and things like that. And at first, your database are not necessarily a huge list of interested investors. It's just people who you met and that are interested to learn more about what you're going to do and keep tabs on you. But then it slowly starts to snowball and develop as people see that you're serious about what you're going to do. So, conferences is another good one. Our meetup. We now have 3 meetups and 2 podcasts. And so there's different ways to start building up that list, but it does take time. And so I was not someone that knew, a bunch of high net worth individuals. And so it was not going to be easy for us to raise money on our first go around. So we knew that we needed to build up that list and take time before we started making serious offers on properties.
Mm-hmm. Yeah. So that's, and also like for me, like a lot of the time, having a deal really facilitate that conversation, because there's a lot of people that, they want to invest, they potentially would want to invest, but then there's kind of like, how much can they actually invest into your deal? And a question of timing. So, if you have a deal now, I have the cash available, but if you talk to me 6 months from now, I may already have invested my little bit of money somewhere
That
else.
is the biggest thing I learned when raising money for the first time, is that it really is all about timing, and not just, do they invest it with someone else, but you get a peek behind the curtains of an actual person's life, right? I mean, this is real money to them that they've earned, and it's hard-earned money, and life happens. And so maybe they just took a vacation, or maybe they're on vacation and they just don't want to deal with it right now, but they do want to invest in the future. Or maybe they just had a baby, maybe someone died in the family. I mean, there's so many different things that happen, and you have to plan for that. And so when you're raising capital, I always tell people, look, if you have commitments, if someone said, yes, I want to invest with you for $1 million, you can only count on half of that at most, I think. And if you get more, great, fantastic. But I wouldn't consider a verbal commitment someone that's definitely going to invest for that specific deal, because life happens, timing happens. And so it's got to be the right time. And I would say 50% or less of those people, it's going to be the right time for that deal. Yeah.
So the last building that we bought in Midtown Memphis, it was a 16-unit apartment building. And I don't know if you talked to Antoine about it, but
I do know about it.
So we were kind of, the deal was delayed basically because of Freddie Mac and all of that. And so then we had a couple of investors. So one of the investor, because we started this like, September, October last year. And then we were waiting on the seller to do a 1031 exchange find another property and all of that. So that was delayed. And then and it was fine for us. We already had identified the investors, and then they were fine. But then that was in October, and then we didn't get their money. We didn't ask for their money until when we were about to close. And then So then one investor bailed out, and then I said, okay, so this now we have to find, and we're not doing syndication. We're just doing like a partnership. We have like 3 or 4 partners on that one, and then so one of the investor bails out and says, I need the money somewhere else, or I don't have the money anymore. And okay, now we have to raise some more money to fill that. And then the scary thing is that one of our investors, we had the money, she sent the money in, but then she said, and then the COVID happened, and then Freddie Mac did things, there was a delay on the Freddie Mac side, and then she said, oh, do you mind sending the money back to me, and then until you're ready to close, then I'll send you the money back. And I said, okay, that's an additional risk. I don't want to be like caught like 2 weeks before closing and say, hey, I changed my mind.
Yep.
So, but luckily, she sent the money back for the closing, and thank goodness. But otherwise, that would have been another headache. But so that's real money. I mean, they want to make sure that that they have commitment. So sometimes that they don't know when things are going to close. There's a big timing issue that is involved, and so you have to be cognizant of that and keep your head cool.
Absolutely.
The other thing too that I know, you mentioned that this is real money, and to me, like, this is something that's very important to me and to us in our company, and I suspect for you as well, is to really respect the investors' money. So we take more risk with our own money than we do with our investors. We want to make sure that our investors' money is as safe as possible. Of course, there's a risk component to that, but for us, like, this is very, very important that we really respect the money that they've invested with us.
Yeah, you have a fiduciary responsibility to protect your investors' money. This is not just, hey, I'm going to get rich because I use other people's money. This is serious. These people work hard for their money, and this is their money that they're trying to put to work to get to the point of financial freedom or build up a nest egg or retire. And, if you're not going to respect their money, you shouldn't be doing this, plain and simple. And, the investor comes first, and their money comes first, their returns come first, and and then we align our goals with them to build and grow together. And I would go a step further, not just respecting their money, but respecting them as a person. We like to have a relationship with our investors, and we would prefer to have a small group of investors that we know, like, and trust, that we can consider growing a friendship with, than 1,000 investors who are just going to give us money that I don't know from Adam. And so we're really, serious, and we take a lot of time, and we put a lot of energy and effort to get to know our investors and celebrate our investors, and eventually grow those friendships with our investors. So absolutely, you have to respect their money, and there's just no other way around it.
Yeah. So I knew we'd be on the same page, so I really appreciate that. But I mean, I find, especially when it's, maybe I see that more like on the smaller, like the flippers and stuff like that. Maybe a little. I saw a couple of things, maybe because I lost some money on that, like actually lending money, being joint ventures on single family flips with some investors, and So, and
I think that's why it's important to, get to know who the people are that you're going to invest with, and you want to know, like, and trust your sponsors. And once you find a sponsor, or, a lead syndicator, or whatever you want to call them, an operator, those people are gold. I mean, because you want to know they're going to do right by you. And once they prove that to you, you got to keep going to that well, definitely, because there's people out there that will tell you, hey, look, it was in the documents that you can lose your money, and I'm sorry, but I lost your money. And that's not really, even though that's in the documents, that's not how we look at it. We want to preserve the capital, and we want to grow their wealth, and we'll do everything in our in our realm to make sure that happens, no matter what.
So So now I think I'd like to transition to your existing kind of like project. If you want to tell us a little bit about it, kind of like, so we have an idea of kind of like what kind of projects you're dealing with, the size, the number of people, and all of that, and
Yeah.
kind of like how you got into that.
Absolutely. So our latest project was we closed in November of last year, and it's 128 units, about $15 million property in Phoenix, which is one of our markets. We focus in Phoenix and Tucson.
Mm-hmm.
And the way we found that one was through relationships. Just like with your investors, you want to have relationships with brokers and partners and all sorts of different people. And this one came 3 weeks after we closed our last property, and it was with one of our partners on our first property.
Mm-hmm.
And he has a full-time job, and he called me and he said, "Hey, Kyle, I got this deal. It's off market right now. We've closed a couple deals with these brokers, but I don't have time to underwrite it. Can you underwrite it?" And I underwrote it that day. It looked like it made sense. Me and my other business partner drove out to Phoenix the next day. We left at 3 a.m. We got there at 9 a.m. And then 2 days later, the first day it went to market, we had it under contract. And so in the market environment, this was last year, of course. Now we're with COVID, so the market's definitely changed. But back then, you needed to act quick and move quickly and show that you were serious about the deals. And that's kind of what we did to separate ourselves to get that deal.
Mm-hmm. Yeah, and I think in Phoenix and Tucson, I think these markets are pretty they're pretty hot. They're very active markets, from what I understand. And so yeah, you definitely need to act very quickly if you want to get the deal. And so building the relationship basically with the people, the realtors and stuff like that. So that really helped you. So it's always about the people. It's always about the networking basically, and having people recognize that you're going to take action. You're going to do something. You're not just kind of like looking around. You're actually, if something interests you, you're going to pull the trigger.
The thing that separated us was we would go out to the markets twice a month. And I still do that right now, even though I live in California, right? I think that a lot of people call brokers, and I still call them on a weekly basis and catch up with them and get to know them and build that relationship. But when you're going out to the market and you're meeting someone face to face, touring properties, buying them lunch, buying them dinner, it's different. They know you're serious, because someone's not going to come to that market every other week. Or every month if you can't make it out there every other week, if they're not serious, right? So, this business is not one that you can sit behind the phone and do all your work behind the computer and behind your desk. Making phone calls is one thing, but if you really want to separate yourself, you've got to get out there and get to know these people. And so that's one thing that we do. We're out in our markets quite often. Yeah.
And for us in Midtown Memphis, interestingly enough, there was definitely a broker relationship that, somebody that helps us brought us a deal in Midtown Memphis a while back, and then he brought us other deals later on. But also, interestingly enough, is the person that we bought our first 20-unit apartment building. He had a portfolio of apartment building that he wanted to kind of like convert into something else. He was looking more towards triple net and kind of upper commercial buildings. So he knew us. So he would contact us before putting anything on the market and say, "Hey, are you interested in any of these?" And then so that was kind of interesting. So he knew we were serious. He knew we could. He also saw the renovations that we did on the previous property that he owned, and then he would get compliments about, "Hey, I saw you fixed up your apartment building. It looks very nice." Blah blah blah. So, well, I don't own it anymore, but so you got so that's all of that really helped build the relationship with him and all of that, and this is why the last one that we bought, the 16 unit that we bought, was from him as well, and that's why it dragged on like this for a while. And he just said, "Oh, I need a little bit more time to find 1031." I said, "Okay, no problem." And then we were able to also, when we needed time, we were also able to, because we had the relationship with him, we were also able to talk to him and say, "Hey, we need an extra month here to fix this thing."
Yep. It's all about relationships. And as you build your track record, things get easier and easier because you have built those relationships, and those relationships can really save your butt in certain situations, you know? So, yeah, absolutely.
Yeah. So what's next for you, Kyle?
Yeah. Right now, you know, we had a property under contract right when the COVID-19 stuff happened, and it dropped out. The seller just didn't feel like, given the situation, that it was going to be able to go through and be able to close because we couldn't do due diligence and things like that. So unfortunately that dropped, and we were really excited for that property and to get a couple more later this year. But, you know, things have changed, and so we've got to pivot a little bit. So we're hoping that it's going to be, you know, towards the end of 2020, you're going to start to see some opportunities. So still continuing to build relationships with the brokers and contact them, and, you know, keep our eyes and ears open. But at the same time, right now, we're focused on managing and maintaining our occupancies at our current properties and working with our residents through this tough time, because, you know, no one's seen this situation. So really our focus is there, and informing our investors and keeping them up to date with the situation. And then since we're home all the time, you know, my business partner and I have decided to merge companies. So we're building out the website right now. We're doing educational content, building out some ebooks, and then even writing a book. So trying to keep ourselves busy while we're sitting here. And, you know, we know the next 2 or 3 months, we're not going to be doing any deals because it just doesn't make sense for us. And so you've got to kind of pivot and think of other ways and opportunities to get ahead. And so we're doing a lot of the things that we probably couldn't get to while we were out sourcing deals. Yeah.
So so as we wrap up here, like any kind of like book recommendations that you had, things that's shattered your world that you want to recommend?
Yeah, I think for just general reading, I love the book Shoe Dog by Phil Knight. I think his whole story about perseverance and how he built Nike was fantastic. From a multifamily perspective, Joe Fairless's syndication book, his most recent one, if you look at that, we're basically following it step by step on how he built his company and how he suggests syndicators build theirs. And so that's been very impactful on our lives.
Okay. Oh, that's very good. And then if you want to, and you mentioned also your meetups and your podcasts and stuff like that. So if you want to send me the links, you can talk about them now. And if you send me the link, I can put them in the comments. So if anybody is interested in following up on the meetups and the podcast.
Yeah, I sent you my bio. And so all my links are actually in my bio, but our podcast is Passive Income Through Multifamily Real Estate. Would love to have people check that out. We've got 2 different episodes. Mondays talks about passive income and how you can build your wealth. So those are for more passive investors. And then on Fridays, we've got an Asset Management Fridays episode where we educate operators on how to become better operators. And so that's a great way. And then you can also check out APT Capital Group.com. And that's where our new website is, and that'll be launching in a couple of days. And I always give out my phone number too, because I'm happy to talk to people about getting started or any way that I can help. It's 562-833-5010.
Okay. Thank you, Kyle. And good luck. Yeah, you have an interesting year ahead. So I think we all do, but for you, there's going to be a little bit of pivoting, I think, that we're going to have to figure out. So good luck. Have a great year. And hopefully we can talk to you a little bit later this year.
Awesome. All right. Thanks for having me on.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.